a problem that started after 2008. We are millions of houses short. Millions. Even at the highest interest rates that an entire generation's ever even seen. Multiple generations have ever even seen. Prices aren't dropping, and it's getting worse as we go. So we don't expect there to be this huge resurgence in the housing market where people are buying something. We think that it will rise. We will see more people buying as it goes. But until we get more units out, prices of homes will not just contract. In 2008, we were oversupplied and interest rates went up, right? We don't have that. With that said, housing prices, we believe, will go down, but it's not, I mean, we're talking regional specific, nothing nationwide, and it will not be dramatic. Okay, with that, where does that put us here now in overall 25? We're talking, we're in the peak. This is why this is so fascinating and so interesting, and why this is the 24 and 25 are the two most important years. 24, the bottom, 25, the start of a new cycle. And we had another video that we talked about this, but this video, we're talking about what that means for us in this year. 25, I do not believe we're going to see dramatic changes in overall demand. The reason being is we are still having new starts roll out, as in supply is still, even though not as much, it's still coming out. It is still more than demand is. That means regionally specific places will get hit disproportionately more. If you add on new supply and it's already weak demand and you're not having a resurgence in movers and everything else, you will see a bigger hit. Mm-hmm. What we'll also see now is the performance of operators has gotten very large.
You're talking the gap in operations.
And what the outcome is for operating and what they can yield compared to another. Mm-hmm. This is once again focused on second and first tier markets. When you get into third and fourth tier markets, generally it's all the same. They operate like traditional real estate. There isn't a huge amount of changes in the supply and demand because people weren't developing there. You didn't have mass development cycles, right? Rates are still relatively the same, occupancy is the same. So some people may be listening and they're like, I haven't noticed much of a difference, right? Well, obviously, if there's no new supply and your type of competitor is not changing, so it's not being more competitive, you won't have, that's traditional real estate economics. Mm-hmm. Simple supply, demand, you have it. This creates a rate runway for these areas though. So I talk a lot about the rate runway. Where are rates going to go? You will see those areas will be disproportionately benefited. Why? Higher interest rates, even though demand's come down, they're going to be short new supply forever. Why? Building cost rose so dramatically through inflation. They literally, you can't go build and charge what you need to charge in a fourth tier market in most markets to make it make sense. It just doesn't economically make sense. The cost of building so high. Add into that 7% interest rates, nobody's building. Mm-hmm. So a lot of these markets, they're going to see high occupancy and they'll see the ability to raise rates, right? Because there's just supply lag.
Yeah.
Doesn't exist.
One-man show.
Yeah. And there's no real good competitors.
Exactly.
You can do little things to outperform. Mm-hmm. Right? Even first tier markets that are going to be totally safe and fine in general are the ones that these are REIT dominated because it's constricted by laws. You think Southern California, where you just can't put new supply out, right? Those areas always do well. That's why REITs buy it. You have the swing markets and the middle markets. These are the ones where you're going to get a very large performance separation because you have REITs, regional players, and mom and pops all together. They were growing second tier markets. So you have inventory also coming in the mix, and yet you have a reduction in people and supply. That's why swing markets are swing markets. These are the markets I play in. I know them intimately. We saw this in 2008. We've seen it through the other cycles. We moved out after I wrote the self-storage bubble, everything else. We actually moved out of the fast growing second tier markets. We moved into markets that weren't growing that fast, and we changed up our philosophy. We've now started to move back into those second tier markets. Why? We're on a new cycle. So we're actually putting out product developments, everything else in these markets that we're very excited about because a 40+% reduction in supply coming, right? That's huge. It's a benefit. So we're very excited about this. And we did the same in 2008. Prior to 2008, we didn't buy anything in those markets. We focused on totally different markets. After 2008, we started buying in fast-growing markets. The problem and issue that people have right now, if you're trying to get in and trying to buy, especially in those markets, the institutional level facilities, they can still command high prices. We sold one of our assets a month ago at a 4.5 cap. So interest rates are 7, and we sold it at a 4.5 cap. So people are willing to pay good products, good operators that can get margin out of it, that they can do things better. And so that makes it harder to find opportunity if you aren't a big shop. Where you find opportunity then is in the 3rd and 4th tier markets, because the next thing that's happening is we're hitting like peak retirement by 2030. This is going to transform the self-storage industry. These 3rd, 4th, and 5th tier markets, baby boomers, mom and pop, they're selling. And this is going to pick up speed. Mm-hmm. And as they do it, buyers are going to come in. You have the largest players that are REITs. They're not buying those facilities. They can't. It doesn't make sense for them to do it. If I am a $50 billion company, the transaction cost of buying a $500,000 facility, it doesn't, like, you'll never make money on it, right? It's a waste of everybody's time.
Yep.
There's huge opportunity in this. You have a good rate runway. You have transfer of assets from generational reasons, real sellers, not because they're going to need a lot of money, but 2, those assets in those markets are affected way more by interest rates. As in, I can't pay you a 4 cap in this market if interest rates are 7%. Nobody can finance it. Banks won't finance it. Nobody buy it. So those sellers have no choice. Mm-hmm. When you are selling to an institution, though, their money isn't predicated on normal interest rates. They sell bonds. They have cash on hand. So if interest rates are 7 and they want it, they can buy it at 4.5, and it's totally different economics. Those small facilities and small markets, they don't have that. So we're buying facilities. We just sold one at 4.5. We're now in turn going and buying ones at like 8, right? That's a great spread for us to shift around our portfolio and assets. Trade out higher, buy in lower cost, higher upside valuation. We're doing a lot of that. And that is a lot of 2025 for us. We're taking chips off the table. We're reallocating capital. We're buying upside right now. And we're buying it at a price where 3 years ago, that one that it was an 8 cap, it was selling at a 4. That's a 50% difference, right? In price. Huge. Massive upside in these things.
You're talking millions. You're talking like some percentage points that it might sound like that. Just hearing it, maybe if you are for the first time.
Yeah.
But you're talking millions or tens of millions in value on a few percentage points.
Because of the timing of interest rates in a year. That difference, I talk a lot about, everybody, intrinsic and extrinsic value. That's what we're playing on. It has good, solid intrinsic value, good renters, good operations, everything else. But the extrinsic value, meaning the buying and the selling of the asset, that's gotten killed because nothing to do with the asset, just markets. That's what I love to do and how we play the game. That's what we did after 2008. That's what we did prior. I love that I'm buying something that has really good fundamental intrinsic value, because things that don't have anything to do with it making money are affecting the price at which I can purchase. Mm-hmm. It goes on sale. And so we're buying and moving into a lot of those. We are very contrarian, I think you could say a lot, because we're developing and we want to develop more right now.
Now's the time.
Now's the time. Yeah. We're opening up huge facilities. We're bringing a market, opening up. We have one of our largest facilities that we're starting this year. It's massive. The whole development site, and everything else.
Well, just go back to that point, and those Yardi statistics, 2028 leading up to that, you're talking about a 40% up to 40% potentially reduction in supply.
Why our population is growing.
Yeah, start now. Drop those things in the next 2 years. Your assets are hitting the market at peak demand.
Yep. This is a great, great play. I've told everybody this. I've said it multiple times. Right now is the best time to start.